Running a business is tough. You've got to make smart choices with your money. That's where cost accounting comes in. Cost accounting is like a financial GPS for your business. It helps you track all the money you spend to make your products or provide your services. With this information, you can make better decisions about pricing, production, and more. This essay will walk you through some important cost accounting formulas. We'll use simple language and real-life examples. You'll learn how to use these formulas in Excel to get a clearer picture of your business's finances. Let's dive in and learn how to make your business even stronger. Total cost is exactly what it sounds like. The total amount of money it costs to produce a certain quantity of goods or services. Understanding this concept is crucial for any business, big or small, as it directly impacts profitability and pricing strategies. It's made up of two main components, fixed costs and variable costs. Each plays a distinct role in the overall financial health of a business. Fixed costs are expenses that stay the same regardless of how much you produce. These are the backbone of your financial structure, providing stability and predictability. Think rent, salaries, and insurance. These costs are incurred no matter what, ensuring that your business can operate smoothly. These costs stay put whether you make 100 widgets or 1,000 widgets. They do not fluctuate with production levels, making them easier to plan for. Variable costs, on the other hand, change based on your production volume. These costs are more dynamic and can vary significantly from month to month. Materials, direct labor, and sales commissions are good examples. These costs increase as you produce more, directly linking them to your output levels. The more you produce, the higher these costs will be. This means that while scaling up production can lead to higher revenues, it also brings higher variable costs. Here's the simple formula for total cost. Total cost equals fixed costs plus variable costs. This formula is fundamental in budgeting and financial planning. Let's say you're in the business of making delicious homemade candles. This example will help illustrate how fixed and variable costs come together. Your monthly fixed costs are $300, rent, utilities, etc. These are the costs you must pay regardless of how many candles you make, and your variable cost per candle is $2, wax, wicks, fragrance. These costs will increase with each additional candle you produce. If you make 150 candles this month, total cost equals $300 plus $2 times 150, which equals $600. This calculation shows how both fixed and variable costs contribute to the total cost. As you can see, calculating total cost is pretty straightforward. However, understanding the implications of these costs can help you make better business decisions. This simple formula provides valuable insight into your overall expenses. By breaking down your costs into fixed and variable components, you can better manage your finances and plan for the future. Knowing your total cost helps in setting the right price for your products, ensuring you cover all expenses and achieve profitability. It also aids in identifying areas where you can cut costs and improve efficiency. In summary, understanding and calculating total cost is a fundamental aspect of running a successful business. It allows you to see the bigger picture and make informed decisions that drive growth and sustainability. Now, let's talk about average cost. This is the total cost of production divided by the number of units produced. Average cost equals total cost divided by number of units. Using our candle business example from before, your average cost per candle would be average cost equals $600 divided by 150 candles, which equals $4 per candle. Average cost can help you determine a reasonable selling price for your product. You obviously need to charge more than your average cost to make a profit. Section 4. Marginal cost, the cost of one more. Marginal cost tells you how much it costs to produce one more unit of your product. It's a crucial concept in economics and business. This is important for making decisions about production levels. By understanding marginal cost, businesses can optimize their production processes and ensure they are not overspending. Let's say you're considering making an extra 20 candles. This scenario will help us understand how marginal cost works in a practical setting. Your variable cost per candle is still $2. Variable costs change with the level of output, unlike fixed costs, which remain constant. Marginal cost equals change in total cost divided by change in quantity. This formula helps in determining the cost effectiveness of producing additional units. Marginal cost equals $2 times 20 candles divided by 20 candles, which equals $2 per candle. This simple calculation can be applied to various production scenarios. In this case, your marginal cost is the same as your variable cost per unit. This is a straightforward example, but marginal cost can vary in more complex situations. This is because your fixed costs are already covered. Fixed costs do not change with the level of production, making them a crucial factor in cost analysis. Knowing your marginal cost can help you decide if increasing production is a good idea or not. It provides a clear picture of the financial implications of scaling up production. Section 5. Contribution margin, covering costs and making profits. Understanding how to cover your costs and make a profit is crucial for any business. Contribution margin is the amount of money each sale brings in after covering variable costs. It's a key metric that helps you understand the profitability of your products. This leftover money contributes to covering your fixed costs and hopefully to your profit. Fixed costs are expenses that do not change with the level of goods or services produced, such as rent, salaries, and insurance. Contribution margin equals sales price per unit minus variable cost per unit. This simple formula can provide deep insights into your business operations. Let's say you sell your candles for $10 each. This is your sales price per unit. Remember, your variable cost per candle is $2. Variable costs are those that vary directly with the level of production, like materials and labor. Contribution margin equals $10 minus $2, which equals $8. This means you have $8 left after covering the variable costs of each candle. That means for every candle you sell, you have $8 to cover fixed costs and make a profit. The higher your contribution margin, the more profitable your business can be. Contribution margin is a helpful tool for analyzing your pricing strategy and profitability. By understanding and optimizing your contribution margin, you can make more informed decisions about pricing, cost control, and overall business strategy.